Welcome to The Explainer. Today, we're going to break down a very structured way of looking at the market. We'll use some really clear visuals to walk through a specific example, one step at a time. So what we're looking at today is an approach called market DNA analysis. We're going to document its application to WTI crude oil, following the progression, phase by phase, just to see how it works. Okay, so every analysis has to start somewhere. For this particular model, that starting point is what's called Phase 1, the entry plan. Let's dive in and see what that initial setup looks like. Here's the chart from back on December 15, 2025. This is our ground zero. The model has identified two potential entry points based on its geometry. See the main one there, marked M? That's the primary entry. And then there's a secondary one, down at PC. These two levels are really the foundation for the whole plan.
Now, a plan is nothing without solid risk management, right? This table spells out the exact parameters for this analysis. It's all based on a hypothetical capital of $100,000. And check this out, a super strict max drawdown of just 5% or $5,000. These aren't just suggestions. These numbers are going to guide every single decision.
So that brings up the big question. How is the actual trade size determined? Well, it's not arbitrary. This quote tells us the core formula. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. That right there is the central calculation for managing risk in the system. Okay, so we've got the entry plan, we've got the risk rules locked in. What's the logical next step? Projecting the potential outcomes. Let's take a look at the risk and return projections that stem from that initial Phase 1 setup. So, the model projects three potential price targets. You can see them labeled T1, T2, and T3. And based on those targets, it lays out two different profit scenarios. Scenario 1 over on the left shows what could happen if only that first entry at M gets triggered. But Scenario 2 on the right, that's the outcome if the price also dips down to that secondary level P of C. And as you can see, the potential return is quite a bit higher in that second scenario.
Of course, a plan is just a plan until the market actually starts moving. So what happened next? Well, the price action triggered a key event, and that moved this analysis out of the planning stage and squarely into Phase 2, mirror contact.
And here's the updated chart, dated December 23rd. After that initial entry at level M, things started happening. This chart captures the first really significant development in this whole documentation. The key event is right here. The price moved up and made contact with a line the model calls the delayed mirror, hitting a price of $58.14. Now, according to the rules of this system, that specific touch is what officially transitions the analysis into Phase 2. It's a major milestone. So that brings us right up to the current status of the analysis. And before we wrap up, it's absolutely crucial that we go over some important disclaimers that accompany this documentation. Okay, please listen carefully. This is not financial advice. The model's own rules prohibit using leverage above 10, and please do not invest essential personal funds you can't afford to lose. The only reason we're showing this is for public documentation and verification of the model's process. That's it. And so, with the analysis now officially in Phase 2, the question becomes, what's next? Will the market's movement trigger the conditions for Phase 3? We're simply navigating the market here, documenting what happens next as it unfolds.